In this video, we will explore about Dupont Analysis, a powerful framework used to dig deeper into a company's return on equity. Often, looking at financial ratios in isolation does not tell the full story. As an analyst, your goal is to synthesize or combine these ratios to gain diagnostic insight. For example, imagine you see a company where sales are growing, which looks great, but at the same time, the collection period is also increasing. If you read these together, the diagnosis changes. It suggests the company might be getting lenient with credit terms just to boost those sales numbers. To systematically break down these drivers, we use the Dupont Analysis framework. To understand Dupont Analysis, we have to look at the formula. We take return on equity or ROE and break it down into three specific distinct components. First is the net profit margin, which measures profitability. Second is the asset turnover ratio, which measures efficiency. And third is the equity multiplier, which measures leverage or capital structure. Mathematically, ROE equals net profit divided by sales multiplied by sales divided by assets multiplied by assets divided by equity. This breakdown helps us identify exactly what is driving the returns. Think of this framework as a weighing scale. On one side, we have operational wins. These are reasons to cheer. If the ROE is going up because of a higher profit margin or higher asset turnover, it means the business is becoming more efficient and profitable. On the other side, we have financial risk. This is a reason for caution. If the ROE is increasing solely because of higher leverage, it means the company is borrowing more money. The takeaway here is crucial. Higher leverage brings higher risk. So, an increased ROE driven solely by debt is not a reason to celebrate. Let us look at a practical example to see how this works. We have the tale of two companies, High-Lev Co. and Low-Lev Co. On the surface, High-Lev Co. looks dominant. It has revenue of 12,000 and a net profit of 2,400. Low-Lev Co. has slightly lower revenue of 11,800. When you calculate the return on equity, High-Lev Co. boasts an impressive 92.3%, while Low-Lev Co. is at 52.4%. At first glance, you might think High-Lev Co. is the clear winner. But now, let's deconstruct the drivers using Dupont analysis. When we break it down, the picture changes completely. Look at asset turnover, which measures efficiency. Low-Lev Co. wins with 2.4 times compared to 2.3 times. Look at net profit margin. Low-Lev Co. wins again with 22% versus 20%. The only reason High-Lev Co. had a higher ROE is the leverage. It has an asset to equity ratio of 2.0 times, indicating high debt, while Low-Lev Co. is at 1.0 times. This reveals that High-Lev Co.'s performance is artificially inflated by high leverage. So, what is the verdict? Our analysis shows that Low-Lev.Co is actually the operational winner because it outperforms in both margins and efficiency. Even though its ROE is lower, this is solely due to lower debt, which is actually a positive thing. In terms of risk assessment, Low-Lev Co. faces significantly reduced risk compared to its competitor. This teaches us a vital lesson for beginners. High ROE does not always equal a better company. You must look at the source of that return. Now that we have analyzed the past, let us look at forecasting using ratio analysis. This involves looking at the past to predict the future. We typically take historical data and ratios and project them forward. However, there is a major trap here. We often assume that past behavior is a fair representation of the future. This need not hold good. The business environment is dynamic, and blindly copying past trends into the future can lead to serious errors. Let us look at a real-world case study of Suzlon to understand this trap. In the pre-2000s era, Suzlon was a monopoly. It had great pricing power and strong financials. If you were an analyst back then, you might have projected that trend to continue forever. However, in the mid-2000s, the scenario changed drastically. Tremendous competition emerged from both domestic and offshore players. The lesson here is clear. Projecting mid-2000s financials based purely on history would have been a blunder. Analysts must always factor in changing business dimensions. This skepticism towards projections is shared by some of the greatest minds in investing. Warren Buffett famously said, "I have no use whatsoever for projections or forecasts. They create an illusion of apparent precision." He wants that the more meticulous they are, the more concerned you should be. He prefers to look very deeply at track records instead. He notes that if a company has a lousy track record but a very bright future, they will miss the opportunity and they are okay with that. His partner, Charlie Munger, is even more direct. He states, "In my opinion, projections do more harm than good." He believes they are put together by people who have an interest in a particular outcome and have a subconscious bias. The apparent precision of these spreadsheets makes them fallacious. He quotes Mark Twain, saying, "A mine is a hole in the ground owned by a liar." This highlights the inherent unreliability of predicting the future. Even the fathers of value investing, Graham and Dodd, agree. They stated that while a trend shown in the past is a fact, a future trend is only an assumption. No matter how careful your projections are, the past can be seen as only a rough index to the future. As a beginner, you should treat all future forecasts with caution and focus more on the proven facts of the past. Finally, let us look at peer comparison. While financials explain past performance, comparing them against peers reveals the competitive position. Context is key here. A 15% margin might look good, but if the industry average is 25%, the company is actually underperforming. The method is simple. You compare ratios across companies in the same sector. This step is critical for investigating a company for a research report, as it tells you not just how the company is doing, but how it is doing relative to the competition.